Hello, strategic management students. I hope you're doing well today. It's Fred David here. If you have your textbook, the 17th edition with you, I'd like you to turn to page 256. I'd like to talk with you for a few minutes about corporate valuation. This is a major business topic, basic business, to be honest with you, to know about how much is a business worth. If it was going to be acquired by another business, or if you were trying to sell the business. I mean, all the way from a small business to an IBM or Hewlett Packard type business. How much is the business worth? That's just basic business. Because to get that 4 to 5% annual growth that shareholders expect, top line and bottom line, as we've talked about, many times companies want to, acquire another business. And so I see, in fact, I see on page 256, there's roughly $1.5 trillion every year of mergers, acquisitions, just in the United States, of businesses buying other businesses. So value is in the eye of the beholder, folks, and there's not a one right, quick answer, but I see on page 256 and 257, there are 4 commonly used ways to determine the value of a business. We're going to call it corporate valuation. And lots of times firms will average the 4 and get a number. You understand, it's a negotiating process. Just like selling your car, you want to sell high and buy low. That's the same thing businesses do. So it's a negotiating thing. So we do have 4 methods here to get a ballpark of how much any business is worth. I see the first method, 1, on page 256. It's called the net worth method. And folks, that's simply the stockholders' equity number off the bottom of the balance sheet, sometimes called owner's equity. It's that number minus goodwill minus intangibles. And if you think about it, the stockholders' equity number, that's the total assets minus the total liabilities. So it makes sense for that to be a commonly used number. And we're going to subtract off goodwill and intangibles. Please understand what goodwill is. Goodwill is a number, it's an asset. If perhaps on the balance sheet under assets, if a firm or company has acquired another firm in its history and paid more than the book value or number of shares times stock price number, then that difference goes in as goodwill. So goodwill is not really something you can touch. It's not good to have too much goodwill. It means you pay more, and maybe the company had a good reason to pay more than they should have, or more than the market price, number of shares outstanding times stock price. But if so, that'll be the goodwill number. So we're going to subtract off goodwill, and we're going to subtract off intangibles. Intangibles, another asset right there below the goodwill row on a balance sheet normally. Intangibles are copyrights, patents, and trademarks. So in other words, the first method to determine how much a business is worth, let's take the stockholders' equity or owner's equity, that number, minus goodwill minus intangibles. Okay, I see another method on page 257. It's going to be net income times 5. So sometimes folks in determining will use that number. It could be a 5-year average net income or 3-year average net income times 5 to get a rough estimate of how much a business is worth. That method many times is lower than these other 4, but still, like I say, it's a negotiating process, you understand. Method 3, I see on page 257, it's in many finance books, called the price-earnings ratio method. Look at that there on middle of page 257. It's stock price divided by earnings per share times net income. And that method will reveal a commonly used value for how much any business is worth, any publicly held business, because obviously we're dealing with stock price there. Okay, so that's one that I want you to calculate. In fact, the template, the good news, folks, is that the template, the strategic planning template you've downloaded from the strategyclub.com website is going to calculate these four methods for you, for your company. I do it also for a rival firm. I mean, you're going to need to insert the numbers there, but still the template will take the mechanics out of that. Okay, I see the fourth method there called the outstanding shares method. This turns out to be the most commonly used method. This is simply number of shares outstanding or issued. Remember, those terms are used interchangeably, times the stock price. So that's a commonly used method. In fact, folks, please know that algebraically, if you set method 3 equal to method 4, you're going to get the same number as long as you use the same stock price and the same earnings. Of course, stock price changes every 3 minutes. And so, but if you use the same numbers, you would get the same values. But anyway, method 4, outstanding shares or issued times the stock price. In fact, if you pay any higher than that, then it'll go in as goodwill. That's if you pay less than that, yeah, it would count as a discount. Okay, so those are going to be the 4 methods. I see for Procter & Gamble on the top of page 257, the input data there to use the 4 methods. It turns out on the average, Procter & Gamble is worth $135 billion. Do you see that? $135 billion. These are actual numbers a couple years ago for Procter & Gamble. The lowest number there is 76 million. Well, actually, minus 13 billion is the lowest number. You know, that means they've got a lot of goodwill. You see that in table 812 on page 257. So we got a high and a low here number, and it averages out to 135 billion. So it would be a negotiating thing if someone were going to want to acquire Procter & Gamble, and it's a barometer for Procter & Gamble to know, you know, with regard to how much they would have to have if someone wanted to acquire them. I'm turning over to page 258, and I see for the top 20 college football teams, a monetary value established for them. You see that on page 258. Now, I see in the reading there in the first paragraph, this was used discounting values or income back to the present value, getting a present value. But I see there Ohio State, 1.5 billion, followed by Texas, 1.2 billion. Right on down to number 20, back in this year, 2017, I see in the footnote there, Florida State was 385 million. So in other words, that's a commonly used technique here that I want you to be familiar with and competent with in terms of strategic management. Folks, make sure on the template you realize on the very bottom row, off to the far right, scroll to the far right, you'll get projected financial ratios. You see this starting to be talked about on page 258. This template is going to automatically calculate your projected financial ratios based on your projected financial statements, which we covered in our last segment. So that's a great thing you'll want to include in your strategic planning project for whatever company you're doing this semester. And you know, the Sanderson Farms example case that we have at the Strategy Club website, certainly they have the projected financial ratios on the end. And it's a good barometer for you to determine, is your strategic plan going to yield prosperity going forward? I mean, what do these projected ratios indicate? So reassure your audience by commenting on a couple of the ratios, for example, return on investment, return on equity, something like that, to show that your strategic plan is indeed has a really, really favorable outlook going forward. So I see the historical and the projected ratios for Procter & Gamble given on page 259. So folks, instead of, I see on page 260, starting to talk about bonds there. Of course, you could raise capital by issuing equity, going to the bank to borrow money, or issuing bonds. If you issue bonds, it's just like going to the bank. It's considered long-term debt. Instead of going to the bank, you're owing investors. So that's the only difference between bank debt and bonds, so to speak. Bonds are where you owe investors instead of owing the bank, but it's treated just like long-term debt. So folks, I hope you've enjoyed chapter 8 here. A lot of skills here worthy of you including even on your resume. If you get good command of these, I consider them just grassroots basic business. I'll be looking forward in your strategic planning project file that you're developing for some company. I hope you're enjoying reading the book, finding it concise, and we're going to move on in our next segment on into chapter 9 on strategy evaluation. Recall from earlier chapters, there were 3 stages in strategic management: formulating, implementing, and evaluating. I mean, managers desperately need to know, are things working out as we expect? And that's what we're going to look at in chapter 9 in terms of evaluating the strategies on an ongoing basis, so we don't wait for it to show up on our income statement balance sheet to realize that things aren't working out. So we'll Chapter 9 will be a short chapter, but important. Please join me in a few moments in chapter 9. Thank you. Good day. Take care.